If you don't know these 10 words, you're investing blind. By the end of this video, you'll understand exactly what your bank, your advisor, and every finance article is actually talking about. Hi, Kane again. I was a starving artist that graduated from theater school. With a ton of hard work, 20 years later, I own properties throughout Ontario. Be sure to watch my biography video to see how I struggled. See the references below to see where I pull this information from. If there are any discrepancies, let me know. This video is for educational purposes only. If you're going to invest, be sure to speak to a licensed professional. Without further ado, let's get started. First up, asset. An asset is simply anything of value you own: stocks, bonds, real estate, even cash sitting in your own account. If it has value and it's yours, it's an asset. That's it. Next one, stocks or share. When you buy a stock, you're buying a small piece of ownership in a company. Buy Apple stock and you literally own a tiny slice of Apple. That ownership can grow in value, and sometimes it pays you along the way. Which brings us to the next term, bond. A bond is simply a loan. You lend money to the government or a company, and in return, they pay you interest, then give you money back at a set date. Example, you buy a government bond, and in the next 5 years, it pays you interest just for holding it. Dividend. A dividend is cash a company pays out to its shareholders from its profits. Example, a company pays you 50 cents per share every single quarter just for owning the stock. Yield. Yield is how much an investment earns you, shown as a percentage. Example, a bond with 4% yield pays you $40 a year every $1,000 you invest. Diversification. This means spreading your money across different assets or sectors, so one bad investment doesn't take you down with it. Example, instead of putting everything into one stock, you own a mix of stocks, bonds, and real estate. Asset allocation. This is how you divide your money between asset classes: stocks, bonds, and cash. Example, 70% stocks, 25% bonds, and 5% cash. That mix is your asset allocation. Risk tolerance. This is how much market ups and downs you can handle, both emotionally and financially. For example, if a 10% drop in the market makes you panic and you sell everything, you probably have a lower risk tolerance. Time horizon. This is simply how long you plan to keep your money invested before you need it. For example, saving for retirement in 30 years is a very different time horizon than saving for a house in 2 years. And last, volatility. Volatility is how much an investment's price moves up and down over time. Example, crypto is extremely volatile. A basic savings account is not. Asset, stock, bond, dividend, yield, diversification. Asset allocation, risk tolerance, time horizon, and volatility. 10 words, and now you actually know what they mean. If you've enjoyed this video, be sure to watch my next one on what are the best passive investments in Canada. Thanks for watching.